Preparing for a financial analyst at Swisscom interview? You've reached Candy Mentor, and this video is for you. We'll walk through 20 key questions you're likely to face. For each question you'll see a sample answer followed by the key points to cover. Subscribe, like, and share, and drop a topic request in the comments. Question 1. Why do you want to work as a financial analyst at Swisscom? Swisscom appeals to me because it combines a strong Swiss market position with a business undergoing constant technological change. As an analyst, I would enjoy translating operational drivers such as customer growth, pricing, churn, broadband adoption, and network investment into financial insight. I also value the company's long-term perspective and public market accountability. My strengths in financial modeling, data analysis, and clear communication would help management make decisions that balance growth, resilience, and shareholder returns. While answering, connect your analytical skills with Swisscom's telecommunications business, Swiss market leadership, technology investment, customer focus, and disciplined financial management. Demonstrate genuine interest rather than giving a generic finance company response. Question 2. What are the key financial statements, and how do they link together? The income statement explains profitability, ending with net income. That net income flows into retained earnings on the balance sheet, while non-cash expenses such as depreciation reduce earnings but are added back in operating cash flow. The balance sheet shows assets, liabilities, and equity at a point in time, and changes in working capital affect cash generation. Finally, the cash flow statement reconciles beginning and ending cash, providing a useful check that the three statements connect correctly. Make sure to cover the income statement, balance sheet, and cash flow statement, including net income, retained earnings, working capital, depreciation, capital expenditure, and the importance of reconciling ending cash across statements. Question 3. How would you forecast Swisscom's revenue? I would forecast revenue by business line rather than applying one growth rate. For mobile, I would model subscribers, churn, net additions, and average revenue per user, separating service revenue from device sales. For broadband and television, I would consider households, penetration, pricing, and bundled offerings. I would then incorporate enterprise demand, wholesale revenue, seasonality, and acquisitions. Finally, I would compare the result with historical growth, management guidance, and Swiss telecom market trends to challenge unrealistic assumptions. In your answer, talk about segment-level drivers, subscriber numbers, average revenue per user, handset and equipment sales, pricing, churn, acquisitions, seasonality, and cross-checking the forecast against historical trends and market conditions. Question 4. Which KPIs would you monitor for Swisscom's telecommunications business? I would monitor both customer and financial KPIs. Important customer metrics include mobile and broadband subscribers, net adds, churn, ARPU, penetration, usage, and customer satisfaction. Financially, I would track service revenue growth, EBITDA margin, operating cash flow, capital expenditure, free cash flow, and net debt. Network quality and coverage are also valuable because they influence retention and pricing power. The strongest analysis links operational movement to financial impact, rather than reviewing each KPI in isolation. Be sure to mention service revenue growth, subscriber additions, churn, ARPU, broadband penetration, customer satisfaction, EBITDA margin, cash conversion, capital intensity, network quality, and the relationship between operating KPIs and financial outcomes. Question 5. How would you assess whether a Swisscom investment in network infrastructure is worthwhile? I would evaluate the investment through an incremental cash flow model. Benefits might include additional subscribers, higher ARPU, lower operating costs, improved retention, and capacity for future services. Costs would include construction, equipment, maintenance, spectrum, and implementation risk. I would calculate NPV and IRR using an appropriate discount rate, then stress test adoption, pricing, timing, and CapEx assumptions. I would also identify strategic or regulatory benefits that may not be fully captured in the base case financial return. Focus on incremental revenue, cost savings, network capacity, customer retention, regulatory requirements, NPV, IRR, payback, scenario analysis, execution risk, and the distinction between strategic benefits and directly measurable financial returns. Question 6. Explain EBITDA, EBIT, and free cash flow, and why each matters. EBITDA measures operating earnings before interest, taxes, depreciation, and amortization, making it useful for comparing operating performance before capital structure and non-cash charges. EBIT includes depreciation and amortization, so it reflects the cost of using long-lived assets. Free cash flow generally starts with operating cash flow and subtracts capital expenditure. For Swisscom, EBITDA can look strong while free cash flow remains pressured by network investment, so I would analyze both rather than relying on one metric. In your answer, distinguish operating profitability from cash generation, explain depreciation and amortization, discuss capital expenditure and working capital, and note why telecom companies can show strong EBITDA while requiring substantial investment. Question 7. How would you build a three-statement financial model for Swisscom? I would begin with historical financials and clearly separate hard-coded inputs, formulas, and outputs. Revenue would be driven by subscribers, pricing, and business segments. Costs would reflect personnel, network operations, content, and equipment. I would forecast CapEx and depreciation, then link operating assumptions into working capital, debt, interest, taxes, cash flow, and the balance sheet. I would include balance checks, scenario switches, and sensitivity tables. The model should be auditable, flexible, and easy for decision makers to understand. Cover assumptions, revenue drivers, operating costs, working capital, CapEx, depreciation, debt, taxes, cash flow, balance sheet checks, scenario controls, and model integrity. Emphasize transparency and avoiding circularity. Question 8. What is the impact of higher interest rates on Swisscom? Higher interest rates would raise the cost of refinancing debt and reduce the present value of future cash flows, potentially lowering valuation multiples. The immediate earnings impact depends on debt maturity schedules, fixed versus floating rate exposure, and hedging. Higher rates could also increase the hurdle rate for network projects and affect customer affordability. I would review liquidity, refinancing needs, interest coverage, and sensitivity to rates, while separating near-term profit and loss effects from longer-term investment and valuation impacts. Make sure to cover refinancing costs, floating rate debt, valuation multiples, discount rates, pension effects, customer affordability, investment hurdles, foreign exchange interactions, and the distinction between immediate earnings impact and longer-term strategic consequences. Question 9. How would you evaluate Swisscom's dividend sustainability? I would start with recurring free cash flow, because dividends must ultimately be funded with cash rather than accounting earnings. I would compare the dividend with free cash flow, adjusted for unusual items, then assess payout ratios, net debt, interest coverage, debt maturities, and future network CapEx. I would also consider earnings visibility, regulatory obligations, and management's stated capital allocation priorities. A sustainable dividend should leave sufficient flexibility for maintenance investment, strategic projects, and unexpected downturns. Discuss recurring free cash flow, payout ratio, earnings quality, debt maturities, leverage, CapEx requirements, regulatory commitments, liquidity, earnings visibility, and management guidance. Avoid assessing dividends using net income alone. Question 10. How do International Financial Reporting Standards 16 leases affect a telecom company's financial statements? Under International Financial Reporting Standards 16, most leases create a right-of-use asset and corresponding lease liability on the balance sheet. Instead of recording the full lease expense within operating costs, the company generally records depreciation and interest. This can increase reported EBITDA, although total economics and cash payments do not change. For Swisscom, leases for sites, buildings, and equipment may be significant. I would adjust comparisons carefully, particularly when analyzing leverage, CapEx, EBITDA margins, and free cash flow. Be sure to mention recognition of right-of-use assets and lease liabilities, EBITDA uplift, depreciation, interest expense, cash flow classification, telecom site leases, and the importance of consistent comparisons across periods and companies. Question 11. How would you analyze Swisscom's cost base and identify savings opportunities? I would segment costs by function, behavior, and controllability, separating recurring expenses from temporary items. Key areas could include personnel, network maintenance, energy, customer service, procurement, content, and sales commissions. I would benchmark costs against revenue, subscribers, traffic, and peers, then identify automation, vendor renegotiation, process simplification, or network efficiency opportunities. Every proposal should include implementation costs and customer risks. Sustainable savings are more valuable than short-term cuts that increase churn or weaken service quality. Focus on fixed versus variable costs, personnel, network operations, customer acquisition, content, procurement, automation, vendor contracts, service quality, one-time restructuring costs, and whether savings are sustainable without damaging growth or customer retention. Question 12. What would you include in a monthly management reporting pack? I would include an executive summary highlighting the most important variances, risks, and decisions required. The pack would show revenue, EBITDA, operating costs, cash flow, CapEx, and key customer KPIs against budget, forecast, and prior year. I would use bridges to explain movements and segment commentary to identify root causes. A forward-looking outlook, updated risks, and recommended actions are essential. The objective is not to provide every available number, but to make performance and required decisions immediately clear. Mention actual versus budget and prior year, revenue and EBITDA bridges, KPI trends, cash flow, CapEx, risks, forecasts, business unit commentary, exceptions, and concise recommendations that enable management action rather than merely presenting data. Question 13. Tell me about a time you found an error in financial analysis. In a monthly reporting project, I noticed that a cost ratio had improved unusually despite stable operating activity. I traced the variance to a duplicated revenue import in the source file, which overstated the denominator. I quantified the impact, informed my manager immediately, corrected the report, and documented the issue. I then added a control comparing source totals with the general ledger and introduced a second-person review for unusual movements. The experience reinforced the value of questioning results that seem unexpectedly favorable. In your answer, use a clear situation task-action-result structure. Explain how you identified the issue, quantified its effect, communicated professionally, corrected the process, and prevented recurrence through controls or review procedures. Question 14. How would you explain a disappointing forecast variance to a senior manager? I would first quantify the variance and separate price, volume, mix, timing, and cost effects. Then I would explain the root cause clearly, distinguishing controllable execution issues from external factors such as market pressure or regulation. I would state whether the impact is temporary or structural and update the forecast accordingly. I would also recommend actions, owners, and timing. Senior managers generally need an accurate explanation and a credible recovery plan, not a defensive narrative or excessive technical detail. Focus on facts, root cause, materiality, timing, accountability, corrective actions, updated assumptions, and concise communication. Distinguish controllable operational issues from external factors without becoming defensive or speculative. Question 15. How would you value Swisscom using a discounted cash flow model? I would forecast unlevered free cash flow from operating performance, taxes, working capital, and capital expenditure, using assumptions grounded in Swisscom's segments and competitive environment. I would discount those cash flows at WACC and calculate terminal value using a conservative perpetual growth method or exit multiple crosscheck. After subtracting net debt and other claims, I would derive equity value and compare it with the share price. Sensitivity analysis on WACC, growth, margins, and CapEx is essential because terminal value is highly influential. Cover forecast free cash flow, WACC, terminal value, tax, CapEx, working capital, net debt, equity value, sensitivity analysis, terminal growth discipline, and cross-checking with trading or transaction multiples. Question 16. Which valuation multiples would you use for Swisscom, and what are their limitations? For Swisscom, I would start with EBITDA because telecom businesses are capital intensive and often have different financing structures. I would also review EBIT, PE, and free cash flow yield to capture depreciation, interest, and cash conversion. Subscriber-based metrics can provide operating context but are less complete valuation tools. Limitations include lease accounting, spectrum costs, network investment cycles, growth differences, regulation, and business mix. I would use several metrics and select peers with comparable economics. Mention EBITDA, EBIT, PE, free cash flow yield, and potentially EV per subscriber. Explain differences in leverage, leases, accounting, growth, spectrum, business mix, and why peer selection matters. Question 17. How would you analyze the financial impact of customer churn? I would estimate the number of lost subscribers, their average revenue, contribution margin, and expected duration. The analysis should also include replacement costs, retention incentives, handset subsidies, and changes in customer mix. I would examine churn by product, channel, geography, contract type, and cohort to identify the cause rather than treating it as one number. A small monthly change can compound significantly, so I would model its effect on revenue, EBITDA, cash flow, and customer lifetime value. Discuss lost subscribers, ARPU, contribution margin, acquisition and retention costs, lifetime value, contract duration, cohort behavior, timing, and scenario analysis. Connect churn movements to revenue, EBITDA, and cash flow. Question 18. How could a price increase affect Swisscom's financial performance? A price increase could improve ARPU and revenue, but the net benefit depends on customer elasticity, churn, downgrades, competitor reactions, and implementation timing. I would model outcomes by product and customer segment, including the incremental margin after service costs and retention incentives. I would also consider contractual restrictions, regulatory expectations, and communication effects. I would present base, upside, and downside cases, because a higher headline price is valuable only if the resulting customer losses do not offset the revenue gain. Be sure to cover volume elasticity, churn, ARPU, customer segments, competitive response, timing, regulatory considerations, incremental margin, communication strategy, and scenario analysis rather than assuming all price increases flow directly to revenue. Question 19. What financial risks would you monitor in Swisscom's business? I would monitor competitive pricing and churn, regulatory changes, cybersecurity, outages, technology shifts, and large network project execution. Financial risks include CapEx overruns, refinancing costs, supplier concentration, foreign exchange exposure, and pressure on free cash flow. I would assess each risk by probability, potential financial impact, early warning indicators, and available mitigation. For example, a cyber incident could create remediation costs, lost customers, regulatory penalties, and reputational damage. Risk reporting should prioritize material exposures and actionable responses. Focus on competition, regulation, cyber incidents, network outages, technology obsolescence, CapEx overruns, leverage, refinancing, supplier concentration, customer churn, litigation, and execution risk. Explain how risks translate into financial outcomes. Question 20. If Swisscom's revenue increased but free cash flow declined, how would you investigate? I would build a year-over-year free cash flow bridge, starting with revenue and EBITDA, then examining working capital, taxes, interest, CapEx, restructuring, acquisitions, and other cash items. Revenue growth may come from low-margin products, while higher network investment or inventory can absorb cash. I would separate timing and one-time effects from recurring changes, then compare CapEx intensity and cash conversion with guidance. The conclusion should explain whether the decline reflects deliberate investment, temporary working capital, or deteriorating economics. In your answer, walk through EBITDA, working capital, CapEx, taxes, interest, restructuring, acquisitions, timing effects, and non-recurring items. Reconcile cash flow carefully and determine whether the decline is temporary or structural. If you are still with us, congratulations, you are much ahead of the rest and serious about preparing for your interview. We hope we were able to add value to your preparation and create some helpful content. Do not forget to like and share this video. Your small act can do great things for us.